Okay, well, welcome everyone to another talk in the New Ideas in Insurance series. Today's guest is Sangmin Oh. He's a graduate student at the Booth School of Business at the University of Chicago. And we were talking just before, he's really written the very first social science paper on the fascinating and important topic of social inflation, which I'll let him explain for those of you who might not have heard of it, but I'm sure everyone has. Uh, the usual ground rules, he's going to talk for 30 to 40 minutes, and then we'll have time for questions. I just want to remind everybody that in 2 weeks' time, our final talk for the season will be Chris Robertson and Wendy Epstein talking about moral framing and health insurance enrollment. So with that, Simon, thank you so much for coming, and the floor is yours.
Great. Now let me share my slides. Okay. Okay. So hopefully the slides should be all visible. Okay, great. So hi everyone. Thank you so much for inviting me to talk about this topic. As Peter said, I am currently a PhD candidate at the University of Chicago Booth School of Business and the Department of Economics. And I'm in my final year, so if you are on the other end of the job market, maybe I will run into you again at the end of this year. So as a student studying financial markets, one of my main areas of interest is trying to understand the various supply side frictions when it comes to the provision of insurance. And the way I'm thinking about social inflation, which is essentially as a mix of law and finance and insurance, is that we think of financial markets and insurance as coming up with products and ways to distribute risk across agents and also across various states of the world. It actually has a nice parallel to law because you can think of law as specifying like a default distribution of risk in various states of the world. So in that sense, law and financial economics, I see a quite nice parallel, and that's sort of what got me interested in this topic. And one last thing is my background is mostly in economics and finance, so there's a high chance that I may be missing some details either in the realm of law or in the realm of insurance regulation. So if you have any suggestions or comments, I'd love to learn more from you today and in the future as well. Okay, so let's dive right in. So the motivation for this project is that insurance companies in general are very good at ensuring idiosyncratic risk from using law of large numbers. They generally find it quite challenging to hedge aggregate risks. So I have some examples here. Um, typically, there's the types of aggregate risk that they find it challenging to insure are this uncertainty associated with forecasting changes in, say, the overall health level of the population. There could be unexpected catastrophe or weather risk, which, as you know, is becoming more prevalent, or in general, this just general uncertainty of not knowing the future. So all of these are the traditional sources of aggregate risk. And in today's talk, I want to talk about sort of a novel, if you call it, um, source of aggregate risk that comes from this uncertainty in the loss distribution that's induced by the legal environment in which insurance companies operate in. Okay, so that's sort of the broad motivation here. Now, the phenomenon, as the title suggests, that I was talking about is called social inflation. It has been on the insurance companies as well as the regulators' agenda for at least the past 5 years. And they're varying definitions that are being used across various reports and various entities. But generally, it describes this increasing insurance claims that seem to be driven by non-economic factors that has something to do with this high cost of liability litigation. So this is the definition I adopted from this 2023 report published by the NAIC. And the key here, of course, is that these are claims, the size in claims has gone up. That doesn't seem to be driven by traditional factors like inflation or the cost of medical care, for example. Okay. Now, this discussion has been quite increasing over time. So here I've plotted the unique number of insurance companies that discuss social inflation in their earnings calls over time in each year. So as you can see, after 2015 and by 2020, practically all the major largest liability insurance groups talk about social inflation when they discuss their earnings call in their earnings conference calls. Now, the definition of social inflation that I will adopt in my study is a bit broader in the sense that I will refer to any shifts in the insurance loss distribution that's coming from social or non-economic factors as social inflation. So one example is what people have been referring to as nuclear verdicts or nuclear awards, which typically refer to these verdicts and settlements that exceed $10 million in value. So an example here is that, an accident that maybe used to cost 100 or 200K in compensation, now that costs like $1 million or $10 million. So there's like an inflation in this value that's not driven by economic reasons. But I interpret this changes in loss distribution a bit more broadly to include the second definition, which could be coming from just expanding definitions of liability. So when COVID first hit, which is now almost 3 years ago, there were some cases being brought to the courts saying that the business interruption coverages, some of which even excluded pandemic liabilities explicitly, still the insurer should be potentially liable for paying out in response to COVID-19. So if you think about this from an insurance perspective, you've written out a certain policy, and then the definition of what you're liable for changes over time after you issue the policy. And that is another source of uncertainty in the loss distribution that's coming from non-economic factors. Okay, so suffice it to say that I will be adopting a broad definition of social inflation. All the empirics and the data will be focusing on the first, but sort of the economic takeaways would be readily applied to the second as well. So for today, I want to talk about three things. So first is, what do these patterns in rising verdicts and settlements look like? So there's this generic observation, and there are many different ways of looking or arguing that the nuclear verdict and settlements has been going up over time. So I will give you some data points on that. Second, I want to talk about how we can assess whether these rising verdicts and settlements are indeed the reason for rising insurance prices. So how can we tease out this causal impact, which is what a lot of the economic questions surrounding this is about. And then finally, I want to talk about the mechanisms behind this causal impact. Now, the main narrative that I have for you, just to preview a lot of the things I'll discuss today, is the following. So first, there seems to have been a sharp increase in large verdicts and settlements. Here, I'm going to loosely define them as those exceeding $10 million in value since 2015. Okay? And the point number two is that because insurance companies are in the business of learning about this risk and updating their risk models as they observe more of these cases coming in, this legal development has quite significant implications for the insurer's perceived beliefs about this loss distribution going forward. Okay, so it's going to induce a shift in how insured believes about future losses related to this line of business. Now, the third point is that these insurance companies, they face financial constraints in the form of capital regulation, and also they face costly external financing. So what this does is, even if you think that the insurance company is just maximizing profits, the presence of these constraints will going to effectively make them risk averse. In other words, they would dislike uncertainty. And because they're effectively risk averse, this increase in uncertainty induced by these verdicts and settlements would have a first order implication for the supply of insurance. Okay, so that's sort of the main narrative, which I will provide more details throughout the remaining time. Now, what I will not talk about is what led to these verdicts and settlements in the first place. If you read a lot of the reports published by like the insurance sector, the regulators, they focus heavily on like what drove these verdicts and settlements in the first place. And here I have what I think is a pretty comprehensive list of all the explanations that have been put forth. So there have been some discussions of tort reforms that were put in place back in the 1980s and 90s that have been rolled back. There has been an emergence and growth of third-party funding of litigation. So here the idea is that you pay a lump sum of money in exchange for an equity stake in a particular lawsuit. There are also some academic research documenting like a discontent towards big businesses. So as a result, if you're in a lawsuit and the defendant on the other end is like a big company as opposed to like a mom and pop shop, then you're more inclined, or the jury is more inclined to give high awards. That's sort of the line of logic, and many other reasons. So, and I will not focus on this in my paper because I am taking this rise as given, and then I'm trying to think about the implications for the stability of the insurance sector. Okay, so let me first talk about some facts about these rising verdicts and settlements. So the data I'm going to show you is coming from a source called Verdict Search. So Verdict Search basically employs reporters to go out and collect information on really famous verdicts and settlements. And they collect information based on the contents provided both by the plaintiffs as well as the defendant side. And it contains detailed information on the date of the accident, the date of the trial, the venue, the description of the accident, and in some cases, the list of insurance companies that were involved. Okay? And I'm going to look at the period from 2001 to 2021. And in particular, I want to focus on these motor vehicle cases, so cases that involved an accident with a motor vehicle that had commercial defendants on the other side. And the reason I want to focus on this is because anecdotally, commercial auto liability line is quoted to be the most impacted by these rising verdicts and settlements. So if you don't find an impact of these legal trends in this line of business, then you're in no man's land, basically. And I'm going to focus on cases where the initial verdict or settlement is greater than $10 million. So you can think of this exercise as just focusing on the very tail end of the distribution of the outcome of all the claims or policies that the insurance companies are underwriting. Okay? And then just for data quality checks, I cross-checked this information from a website called topverdict.com. So this is a website where the personal injury lawyers, whenever they have a big win, they go to this website and they can submit really big cases. And at least for the top 300 cases I have in my data, they perfectly match. So I think the data is quite robust in that sense. Okay. So here's the first figure. So I want you to first focus on the left axis. So in the bar graph, I've plotted the total sum of all the awards that are greater than 10 million over time. Okay. So you can see that from 2004 to 2014, in each year, on average, there has been about $500 million in total value of these verdicts or settlements that exceed $10 million. And then after 2015, you see that on average, they have about a $1 billion in total amounts in each year. Now, I combined 2020 and 2021 here because in 2020, the courts were closed and the cases were close to zero. And then in 2021, the number actually reaches almost 2 billion. So I just averaged the 2 years just to give you, to reflect the fact that courts were closed and the cases were sort of delayed. But nonetheless, you see this sort of a shift in regime between a sharp contrast, if you call it, between the pre-2015 and the post-2015 period in the incidence of these really large verdicts and settlements. Okay, so that's what the bar graph here is showing. Now the line graph here plots the average premium change in commercial auto liability across each years. So this data is coming from this quarterly survey done by the Council of Insurance Brokers and Agents. And they survey the major insurance companies for how much they change their rates in each line of business. Okay? And the narrative of social inflation is that in the recent 5 to 7 years, this rise in verdicts and settlements has been the first order responsible for explaining this rapid rise in insurance rates for this particular line of business. Now, of course, this evidence is descriptive, so later I will talk a little bit about how we can really say or make the claim that this evidence is causal. But for now, this graph that shows the rise in verdicts as well as the price changes reflects what a lot of reports are discussing these days. There's also quite a
Can I just really quickly ask
yes.
to go back? So these are still quite rare, though, right? These are considered outliers.
Yes.
Are they 1%, 0.5%, 10% of all the cases? What's just a rough sense of that?
Yeah, so I think for the number of verdicts that exceed like 10 million, there has been about 600 cases in the past 10 years. Okay. And then I think if you look at the number of claims in each year, they're in the orders of tens of thousands in the insurance sector. So in terms of numbers, it's actually not that big. Yeah. And this actually ties nicely back to my point I want to make later is that if you think about what the impact of these verdicts and settlements are, the very fact that there are not that many compared to the total number of policies that are underwritten, and plus the fact that the insurance companies their losses are still limited by the policy limits, right? They're not going to pay the entire 50 million. So that suggests that maybe this increase in the average cost per policy might not be the driver of this rate increase. In fact, what I'm ultimately going to argue is that the incidence of these verdicts and settlements, their first order effect is on the uncertainty about losses, right? If you read a lot of the reports, what they'll say is that up to 2014, we were relying on historical data. We had a certain outlook and model of modeling this risk. But now you see these shocks, and now we have to question the model that we use. We have to adjust to account for these large shocks. Plus, we don't really know what's driving these verdicts and settlements. So all of these factors will actually just increase a lot of uncertainty about these losses. And that uncertainty can actually be the reason why these prices are high, even if the insurance company's losses are limited by policy limits, or the fact that these are just represent a small fraction in terms of numbers of the total policies outstanding. So that's where I'm ultimately going with this.
This is Bernie. I just wanted to offer that total commercial auto premium is in the range of, well, it's most recently 60 billion, but over the time frame is probably between 40 and 60 billion. So if you're talking about 1 to 2 billion in these mega catastrophes, you're talking about, a few percent of the total. And then I guess my question was, have you been able to check to see if there was an increase in the incidence of catastrophic commercial auto accidents that might be driving the increase in the number of large settlements or large verdicts?
Yes, so thank you for that question. I don't have it here for now, but there was one exercise where I did to see whether the total, so over time, this rise in verdict and settlements is not matched by this increase in the severity of accidents that would result in casualties, right? So if we think of that as sort of the supply of potential verdict and settlements, it seems that this trend, this explosive trend, is outpacing a lot of that. Now, in the cross section across states, which actually I have it on the next slide, across states, the number of accidents does seem to do a pretty good job of explaining why some states are more prone to this than other states. So like Texas, Florida, or California, these are states where a lot of commercial vehicles are making routes. And as a result, a lot of these states that have a lot of these verdicts and settlements are the ones with the highest number of traffic deaths involving car accidents. So in that respect, it does correlate quite nicely with the incidence of these verdicts and settlements. Yeah, so yeah. Now, one additional exercise I wanted to do is just looking at the cross-section of these verdicts and settlements in each year. So one outstanding question is, it could be the case that that trend is just simply driven by each case size remains constant, but there are just more cases in each year. What this graph is showing you is that that's not the case. So on the graph on the left, what I've done is I've just computed the average size of these verdicts and settlements in each year across the cross section, and then just normalize that value to the value in 2004. Okay? So again, if you just think about the average size of these verdicts and settlements, it stays pretty constant over time, and then after 2015, it becomes twice or even 4 times as large as the value in 2004. Now on the right, I'm computing, again, across the cross-section of verdicts in each year, the dispersion. So in this case, I'm using the standard deviation as the measure. And you also see that just the dispersion in the magnitude of these verdicts has also gone up over time. So this is to say that this increasing dispersion in verdicts could be reflective or could add to the increasing uncertainty faced by the insurance companies. Here's one last way that I've making this point. So typically, when we model the house, like price of house, we model house as like a function of characteristics. So you can do the same thing here, where you model the size of the verdict and the settlement based on the characteristics of each case. So in this case, what I've done is I use the data from 2001 to 2007, and then I estimate a model, just a linear regression model, of the size of the verdicts and settlements on the left-hand side, and I express as a linear combination of the number of plaintiffs, the number of defendants, the number of lawyers involved, the number of experts that were called into each case, the jurisdiction in which the case happened, all of these characteristics, so that I can predict the size of the verdicts and settlements based on characteristics. Okay? So I trained that model using the data from 2001 and 2007, and the exercise I want to do is to ask, how well does this model of verdict and settlement size perform in the period after 2007? And the bars and the here I plotted here represent the forecast errors. So this just represents, for each case, I take the actual size and I subtract the predicted size from this model, and then I just plot this distribution in each year. Okay. So what this is telling you is that prior to 2015, this model trained on old data does perform pretty well in explaining the size of these verdicts and settlements based on the characteristics alone. But post 2015, you see that not only are the errors much bigger on average, so what this is saying is that the model is under-predicting the size of the verdicts and settlements, but also the dispersion in the errors has also increased over time as well. And again, this all of this is to say that maybe this trend is reflecting of insurers' higher uncertainty about the loss distribution. Okay. So having established some facts about this rise in verdicts and settlements, I wanted to briefly talk about how we can think about extracting the causal impact of these verdicts and settlements on insurance prices. So broadly speaking, there are two ways to think about this. The first strategy is the following. You fix an insurance company, and typically a large insurance company would operate in multiple states. Okay, so the idea here is that you focus on the same insurance company, but you compare across two different states, say like Texas versus like Iowa, that have different risk exposure to these verdicts and settlements. Okay? So then what you should expect is that in the states where there's a lot of risk exposure, you should see the price of insurance be very sensitive to the incidence of these verdicts and settlements. Whereas in the states where this doesn't really matter, you shouldn't see much response. Another exercise you could do is you again fix the same insurer, but you're now comparing different lines of businesses. So to use auto as an example, the commercial auto liability line is much more affected than personal auto liability line. If the narrative is about let's sue people on the other side, if they're like Amazon or Walmart because they have deep pockets and we can extract more surplus, as opposed to like a local shop that got into an accident. So if you think that's true, then what you can do is you fix an insurer and then you compare the response in commercial auto versus personal auto insurance. So that's what the first strategy would aim to do. There's another strategy that you can use where you're again comparing, you're fixing an insurer and you're comparing across states and lines with different risk, but now you're comparing it between the pre-2015 period and the post-2015 period. As I showed you in my earlier graphs, there seems to be a regime shift in the incidence of these verdicts before 2015 as opposed to after 2015. So using that temporal variation combined with this cross-sectional variation across states or across lines, you can also show that the incidence of these verdicts and settlements had a causal impact on insurance prices. So here's one example. Here I've plotted the average price increase. So the price increases data is obtained from SNL Financial based on the rate filings that all insurance companies are required to do. For two types of businesses, the red here represents the commercial auto line, commercial auto liability line, and then the blue line here represents the personal auto liability line. Okay? And then here I've plotted the duration of the settlement that involved the comedian Tracy Morgan, who in 2014 was involved in an accident with a Walmart truck and then led to quite a huge settlement that was covered quite heavily in the media. Okay? So combined with that regime shift in 2015 I talked about and the settlement, I can use the 2015 as a source of temporal variation and see how commercial auto has diverged from personal auto in terms of prices. Okay? So what this is showing you is that prior to 2015, the average price increase for the two lines were moving in lockstep pretty much. But then after 2015, you see them gradually diverging with the personal auto insurance rates averaging about 2 to 3% per year, whereas the commercial auto liability lines increasing price every about 6% each year. Now you can do another exercise using a cross-state variation. So what I did is I took, so the National Health Administration publishes for each state in each year the number of traffic deaths per each accident. So, per each car that travels in that state. Okay? So the high exposure states right now are the top 10 states with that highest number of deaths per capita, whereas the low exposure states are the 10 lowest states in terms of death per capita in 2014. Okay? So in essence, I'm assuming that in states where there are a lot of accidents, normalized by the number of cars or population, they are more exposed to these verdicts and settlements. And again, pre-2015, you see that for both the low exposure and high exposure states, the average price increase are pretty much parallel. But then after 2015, they start diverging with, again, about 4 percentage points difference in each year between these two types of states. Okay? Now, in the paper, I'm more formal with respect to the econometrics in trying to make this claim. But broadly speaking, the idea here is that you can use some temporal variation, in which case is 2015 in my case, as well as some cross-sectional variation either across states or across different lines of businesses to get at whether these verdicts and settlements have indeed led to higher insurance prices in this line of business. Okay. So in the remaining time, I wanted to talk a little bit about the mechanisms behind this price increase. So as I alluded to earlier, one immediate implication of these is that it could lead to an increase in the average cost of each policy. But again, as we know, the insurance sector in general spends a lot of effort to learn about social inflation. They meet every year, they talk about this, they share the same database and modeling claims. So in the process of updating and learning about this risk, you can actually have greater uncertainty in the loss distribution. So here I have a simple model of thinking about this. So here I'm thinking about a hypothetical insurance company that tries to learn about the parameters of a certain risk. Okay, so it has some mean mu, and then it has some variance sigma. And importantly, there are two regimes related to this risk. So there's regime 1 that happens with probability pi, and then there's regime 2 that happens with probability 1 minus pi. So the way I want you to think about this is regime 1 is pre-2015 period, and then regime 2 is the post-2015 period. And I showed you earlier that the average size of this case and the dispersion in this case is much higher in the post-2015 period. Okay? So what that means is mu1 and sigma 1, which is the mean and the variance of this risk in pre-2015 period, is going to be much smaller than mu2 and sigma 2. And then I'm going to let the insurer learn about pi. So the goal of the insurer is to figure out which regime we are in based on the observed verdicts and settlements. Okay? So after learning, the insurer will have some posterior probability about which regime we're in. So I'm going to call that pi hat t. And with that probability, then the uncertainty in the loss distribution, which is the total variance of this risk, is given as the sum of these two terms. Now the first term here is just the probability weighted average of the two variance regimes. There's pi hat t is the probability that you're in regime 1 after having observed these verdicts and settlements, and it has some variance, and then with the remaining probability you're in regime 2, which has some variance. But there's a second term that appears in this expression, and this expression actually reflects the uncertainty about the fact that you actually don't know which regime you're in. Okay? So the fact that we don't know which regime of verdicts and settlements that we're in, that actually can increase the variance associated with this risk. So here I have a simple example through a simulation. So what I did here is I simulated the first 200 points of data from regime 1, which again I told you has lower mean and lower variance. And then after the 200th observation, I simulate about 100 more data from regime 2, which is a higher mean and higher variance. So the first graph here at the top shows you that as the insurance company is learning about which regime she is in, because the data is coming from regime 1, she does a pretty good job of her posterior probability getting close to 1. So at this point, the insurer is pretty sure that we are in regime 1. But then once she starts seeing these really outsized verdicts and settlements, you reduce your probability that you're in regime 1 because now you're thinking that this might be regime 2. Now in the bottom panel, I plotted the total variance, which again is given by this term right here, of the insurer over time. Okay. So what you see here is that as you're becoming more sure that we are in regime 1, so again, I want you to think of this as the pre-2015 period when everything was calm and stable, your variance decreases monotonically. But then at this regime change, you start to see more new data, your uncertainty can start to creep back up again. So this particular simulation addresses sort of a conventional wisdom that, at least if you're in the Bayesian learning literature, if you're learning about something that's normal, and if you're learning from data, your variance can only monotonically decrease. But at least in this case where there's regime shift, this added uncertainty here about which regime we're in can actually have a significant impact on the uncertainty about risk.
Well, can I just quickly? So presumably at some point you're going to figure out that you are in regime 2 as long as it stays there, and
yes,
then it'll go back down again.
Yes. So, yes. So this second term is maximized at 0.5 because that's this pi and 1 minus pi. So this component, as you're becoming more sure that now you're in regime 2, this will decrease. But then because regime 2 has a higher variance on average, it will plateau to a higher level than the previous regime. Yeah, you're absolutely right. Okay. Now in my paper, I have a more formal model of how to think about this. And so in the model, I have an insurance companies that assume to be risk neutral. And by assuming that the insurer is risk neutral, you are essentially forcing yourself for the insurer to not care about uncertainty. The insurer, at least when she's risk neutral, only cares about the expected loss of the policy that she's underwriting. And the insurer maximizes expected profits subject to financial frictions. And this financial friction will enter the model in this following fashion. The insurance company is making a pricing decision at the beginning of the period, but is subject to risk-based capital requirements at the end of the period. So what this implies is because when they sell a policy, they have to set aside some reserves. Their decisions about how much reserves to set aside is first order concern here, because depending on how much reserve they set aside, it's going to determine the level of equity that we'll have. And because this risk-based capital requirement is about the equity of the insurance companies, their beliefs about the loss distribution will be essential in this pricing decision. Now, if you go through the math, it will have the model delivers this analytical expression for the price of insurance. So in this example, the left-hand side PIT is just the price of a new insurance policy that the insurance company I charges at year T. And it'll have it's going to be the product of 4 things. So zeta T here represents all the drivers of prices that has nothing to do with these verdicts and settlements. So just think of zeta T as just inflation, the level of price, the price level in time T. And then you have this first term here, which is the expectation of this risk at time T. So this represents the average cost per policy that you expect to have based on your updated beliefs about the loss coming from social inflation or these verdicts and settlements. The third term here represents the markup that an insurance company would charge based on the fact that they have some form of market power. And as is standard in an economic model with market power, the markup will depend on this demand elasticity that the insurance companies are facing. So if they are facing a more inelastic demand, they will be able to charge a higher markup. And finally, you have this last gigantic term here, which represents the following. So lambda IT is, you should think of lambda IT as reflecting how constrained the insurance company is. Okay. Now, this term right here represents the fact that when they're more uncertain about the level of losses that they're insuring, that means the risk-based capital requirement that they will have to face at the end of the period will be more likely to bind, because now more extreme events are going to be more likely to happen. So as a result, you have to set aside more reserves to satisfy the requirement, and that's what this term here is reflecting. So if there's more uncertainty, the numerator here will increase. And because lambda IT is positive, this entire term will increase in response to higher uncertainty, and that will lead to higher insurance prices according to this equation. Okay? So that's the sense in which both the first moment of risk, which is the first term here, as well as the higher moments of risk matter in this case, because they're interacted with this financing friction that insurance companies face. Okay. So let me just recap and conclude with a few discussions about policy. And the paper in the current version has a lot of discussions about the drivers of social inflation. But today I just wanted to focus on understanding the economic implications of these risks. So I've shown you that there has been a sharp increase in these large verdicts and settlements since 2015. And importantly, these are not some idiosyncratic shocks that can be diversified away just by pooling risk as insurers do. It actually represents a shift in the undiversifiable component of risk in these liability policies. And as they learn and update their models of risk, these legal developments lead to a shift in their beliefs about losses, which, as I said earlier, affects not only the first moment of the losses, but also the higher moments, in particular the uncertainty. And because they face financial constraints in the form of capital regulations, this makes them effectively risk averse. And we know that risk averse agents really dislike uncertainty. And as a result, when they price this insurance, they have to charge a risk premium to be able to hold this risk on their balance sheets. Now, one last thing I would say is that if you look at this pricing equation again, the actual level of losses that enters is the first term here. So what this implies, if uncertainty is really driving the price increase, what you should see in reality is that the loss ratio should not be spiking up. In fact, they could be making more profits just because the fact that they're facing a very inelastic demand curve on the other side. And a lot of the higher price is simply driven not because on average the policy incurs more losses, but because the insurance companies are more uncertain about the loss they're underwriting. So all of this is to say that there are some industry reports looking at the loss ratio of some insurance companies or particular lines of businesses, and then drawing a conclusion that because the loss ratios have not been increasing substantially due to these verdicts and settlements, these may not matter for the supply decision. Now, that may be true if the supply decision is driven by this average increase in losses, but at least if you take the model seriously, it will tell you that, in fact, if it's purely driven by uncertainty, then the price margin per policy can actually increase because the losses have stayed the same. It's just this component that has increased. And as a result, the time series of loss ratios may not be the most informative thing to draw conclusions about whether verdicts and settlements matter for their supply decisions. Now, lastly, I wanted to make a broad takeaway of how this connects to a broader discussion about intermediaries and economics. So in general, we care a lot about how frictions in financial markets affect firms and investors. And this is because various intermediaries like banks and insurance companies, they face financial constraints in the form of capital regulation, or it's very costly to raise new equity, and therefore they face costly external financing. Now, typically, when we think about shocks to these financial constraints, we think about them as originating from realized losses today, right? So during the Great Recession, for example, the stock market drop had a big impact on the balance sheet of the life insurance companies. There are a lot of weather risks. Hurricanes had a big impact on reinsurers, for example, and many other examples that really focus on things that happen today, and then they reduce the value of the balance sheet of these intermediaries, and then the effects sort of propagates through either product pricing, like in my example, or the investment decisions of these intermediaries. What social inflation I find very interesting is that this can actually serve as shock to beliefs about future losses. And even if it's just about beliefs about future losses, because insurance companies are in the business of forecasting risk, these shocks can actually serve as de facto balance sheet shocks, like stock market drops today, or like the incidence of hurricanes today. Okay, so that concludes my presentation, and thank you again for listening.
Wonderful, thank you very much. So if you have questions, maybe the best thing to do is to chat them to me, because with this screen up here, I can't really see many people at once. So raising your virtual hand will not help. I have a lot of questions, but I'm going to try to keep to one, because I know other people will have them too. Can I just ask about the capital constraints argument that you went through? And in the paper, you did some other stuff where you looked at how constrained the firms were, and you found that that made a big difference. That most of the price increases came from the firms that had less than average reserves. But I had a question about the magnitude of these effects. So given what Bernie asked you about before and what I asked you about earlier, so these actual extreme events, these nuclear losses, are relatively rare. Wouldn't the size, if you're a large insurance company, the chances that you're going to need more reserves to cover one of these things, if it's only 0.1% of your business or something like that, can you justify how this? Wouldn't that be de minimis for a large company, even though these are $20 million awards or $50 million awards? In terms of the capital that's required, you now have to set aside more capital because now there's a chance that you're going to have, but there's just not that many of them. And if you're small, okay, maybe that's different. Or am I missing something?
No, I think so it depends on what you think the insurers do with respect to their model for reserving decisions, for example. So in a world where you think there are no disasters, the first time you see a disaster, you start thinking maybe we have to update the model to account for disasters. Now, presumably that model that you use to make reserving decision applies to all your policies, right? You cannot pinpoint to specific policies and say, I think this one will become a disaster in the future while this one will not. So a lot of the argument I'm making is based on the fact that they don't know which specific policies will become nuclear. And as a result, and the risk models they use, their beliefs about losses, are very sensitive to incidents of these outliers when they lived in a world where these outliers were not the norm, which I'm saying is the case based on these observed trends, verdicts, and settlements. So as a result, what would matter for that balance sheet is an insurer that underwrote a lot of policies in commercial auto as a fraction of the total balance sheet. Those will be the highest, most hit from this developments, because that affects the biggest portion of their balance sheet. So I would say what matters is not the total size of the insurer per se, but the share of lines of businesses that are affected by this risk, because presumably the way they make reserving decisions and pricing decisions are based on a model that's shared across all the policies.
And so the paper also talks a little bit about policy limits. Does your argument require that basically policy limits are not really meaningful or at least there's a risk that they're not really meaningful? Because if you can just know what your maximum exposure is, because the policy only covers 15 million, then a $50 million verdict is just not going to harm you at all. And what evidence is there? And this would be a great question to the audience, because I'm not in a position to know. But what evidence is there that it's a real risk that you're going to go over by a lot? I mean, I know this can happen, but is that something that you really think insurers need to worry about or do worry about?
Yeah, so I think the policy limits matter in the sense that, suppose in the pre-2015 regime, hitting the policy limits was like a very frequent event. In that case, I don't think these developments will have a meaningful impact. But if the average cost of policy was way below the policy limit in the first place, then as long as the average cost is increasing within the policy limit, to that extent it will have a material impact on how they perceive this risk. Now, I think, at least based on my experience, and I'd love to know more about this, my understanding is that a lot of these commercial policies are more bespoke and adapted to the purchaser as opposed to personal policies. So it's been quite difficult to get sort of standardized characteristics for a commercial policy and the prices associated with them. And in my paper, I used the the product filings as a proxy for how much they want to change the product characteristics. But presumably they could, I mean, I think the rate filings, the contents of the rate filings are also available. So presumably one could look at that to really see in which dimensions of the policy that they're really trying to limit the risk they have to these developments. Yeah.
Okay, next up I have Travis.
Great. So, and this will betray my massive ignorance of this area, but my impression was that when you have a situation like this, that tends to drive, especially large companies like Amazon and Walmart, or maybe even much smaller smaller ones, to self-insure, or to create a captive or do something like that to basically exit the sort of the normal insurance market. And so this is just a question to you, like, I mean, do you know whether that's happened in the face of this, and would that reflect or be reflected in your data, or have any interesting implications for this?
Right. So I think that's when firms are making a decision to self-insure, I think my understanding would be that's mostly going to be driven by the exits of insurance companies. So there's some anecdotal evidence that a few years ago, like Zurich exited a certain portion of their businesses because it was no longer profitable, in which case firms would then, if they can't find coverage, they will be sort of forced to self-insure. And I say this because just from a welfare perspective, like the insurance sector exists because they can pool risks and provide coverage at a much cheaper cost. They can basically diversify away idiosyncratic risk. So from an aggregate perspective, it is much more efficient to have the insurance sector provide insurance and all these firms purchase insurance from the insurance sector. So my guess would be that the firm's decision to self-insure would be just be driven by the lack of coverage on the supply side rather than them finding it cheaper to insure against these losses themselves.
Just to follow up on that, though, I mean, and a market that I know a little bit more about with health insurance, like the point you're making is true as a theoretical matter, but because self-insurance is regulated quite differently than like proper insurance, and the reserve requirements are lower and the sort of overhead is lower, it'll often end up being cheaper, even if you're leaving some of the sort of risk pooling benefit on the table by having a smaller pool.
Yes, I completely agree with that. Yes. So unfortunately, I haven't looked into it yet, but I think it would just trying to understand how the real sectors respond to these developments would be very interesting as well. Yeah.
Agreed.
I completely agree with you on that point. Yeah.
Who else? Andrea, you had an interesting question in your paper about reinsurance. Did you want to ask that?
Sure, yeah. I'm not sure of your familiarity with reinsurance, but I was just curious what you think the implications of this concept of the um, social inflation would have on the reinsurance market.
Right. So generally, we think of the reinsurers as facing a similar constraint. So there were like earlier papers in the 1990s looking at the financial capacity of the reinsurers actually has an effect on the insurance ability to underwrite, and then as a result, it has an effect on prices. So to the extent that these legal developments are not purely diversifiable on the reinsurer side, I think it would matter for sure. One interesting thing about these legal developments is that a lot of these large verdicts and settlements seem to be coming from the common law system countries. So if you're a reinsurer that's hedging geographically across countries, then there might be more capacity than compared to a reinsurer trying to reinsure like climate risk, where the risks there could be more correlated across geographies. Now, I haven't looked at specifically on the reinsurer side, but that would be my guess. And there have been reports put out by the reinsurer side as well. So it seems to be definitely on their agenda as well.
Can I ask just a quick question that might not be fair, so you can just tell me. But where does this phrase even come from? Like, have you tried to look at who coined it and where does it? I mean, it might make a difference to me if I thought, oh, what this is like the National Association of Insurers trying to come up with like oh, we need some good PR for why things are terrible and we need to be able to have more regulatory freedom or whatever, versus, I don't know, an academic who sort of observed that this was happening. Do you have any sense of where this originated or how it got to be a thing? And the other thing is related to that is the Tracy Morgan, like the graphs that you show are very compelling. Something seems to have happened in 2015, but it's a little hard for me to believe that Tracy Morgan set this whole thing off. I mean, I know you're not treating it causally, but do you have a comment about that too?
Yeah, first, so my understanding is that the term was coined by Warren Buffett in his letter to shareholders like in 1977, or in the late 1970s, where he was just talking about why insurers were becoming less profitable over time. And then was basically talking about these non-economic reasons that led to higher liability, the price of insurance, basically. So that's where the term comes from. And then I think when during the medical malpractice crisis in the 1980s, that I don't think they used this term, but then they started using this term, like the entire insurance industry started using this term in the late 2010s. So that I think that's sort of the origins of that term. And regarding the Tracy Morgan incident, so I think what happened is in 2015, there were a number of things that happened together that just raised the awareness of the insurance companies and really shifted their beliefs about this risk. So I think one is if you remember the graph I showed you earlier, the biggest peak was in 2015. So that was, it's right here. Like that was the year where these vertical settlements were really, really frequent and really, really big in magnitude. And that combined, presumably with an accident that was featured more prominently in the media, my guess that 2015 was why we can think of that year as something happened, something shocked their beliefs about losses. Yeah.
Okay, so Bernie Birnbaum, did you have a comment or question? You're still here?
I just wanted to share the recent report by the Consumer Federation of America in which they updated their analysis of the social inflation claims made by industry. And in terms of commercial auto liability, what they've noticed is a strong and growing divergence between incurred claims and paid losses, suggesting that insurers are over-reserving or padding reserves. So I wanted to just offer an alternative explanation, which is the tendency of the insurance industry to engage in groupthink, where their trade associations and their insurance institute, information institute engage in these campaigns to promote tort reform, in which they coin a phrase and then sort of bludgeon it. So just wanted to suggest that perhaps it's that type of activity that's driving what Mr. O is seeing, as opposed to the actual data, which suggests that paid losses have not been increasing as rapidly as incurred losses.
Okay, so I didn't know that there was a new version. I remember reading the old version, but you're saying there's a new one out that I should check out.
Anybody else? Peter Kotchenberger, you sort of ventured a comment there, and I don't mean to cold call you, but
Oh, okay, thanks. Well, first, it's great to have empirical, unbiased empirical research in this area, because there's very little, I think, and so thank you for that. I guess one thing, I'll just have, I guess, 2 points. One is, I'm still not sure I understand the limits. I think the limits are actually a very good way, historically and currently, on managing uncertainty. And so that's one issue. But my broader issue is, I think it's social inflation, cause of social inflation, and calls for tort reform. This debate, at least I can only date it back to when I was in law school, which is a long time ago, but at least for 40 years or more, it's the politics of tort reform, not any of tort reform. The politics that are important, not any empirical data to the extent it's actually available. I mean, they might present some, But the arguments, industry white papers, which are not really white papers, they're government affairs documents, and plaintiffs, the trial lawyers, the plaintiffs' lawyers, similar documents. They have nothing to do with unbiased, research trying to understand the problem. They're advocacy pieces, and to rely on them at all as a suggestion, as a background, I think plaintiffs, but we see mostly the industry. I've read a decent number of them. There's almost, there's speculation. There's a lot of reference back to, this insurer said this paper and this insurer said that. And the only data that I'm really aware of is the commercial auto. And we've already talked about that. And you mentioned that, but I'm not sure how much it does drive, because even given it has, a verdict has indirect effects outside of simply commercial auto rates, that it's still, I think I just checked, it's about roughly 5 to 6, 7% of the overall property casualty premium market. It's simply, compared to private passenger auto, other areas, homeowners in other areas, it's simply not a major factor. So to derive a whole, and this is more common maybe on policy, on public policy, to derive calls for, to change, to alter the tort system again, is based on a very small percentage of the overall, premium in this industry, with all the other limitations that you mentioned, seems to me a very problematic. So that's, I don't know how you separate, and I'm glad you're doing it as much as, I don't pretend to understand economics. I think in this area, it's almost impossible to separate politics from the information we all receive. For example, I don't think the regulators actually are all, have brought up or really concerned about tort reform, except to the extent of social inflation. The industry has repeatedly told them that they should be concerned outside of, Florida. I think this is more of a political movement than an empirical one, but thank you. Again, I think it's great. I wish I understood the economics better.
Great, thank you.
Yeah, and to be fair, he wasn't saying that therefore, given what I found, we ought to do X, Y, or Z for the whole world of insurance. So, yeah.
No, I agree. No, this would be, and then but any of all of this plays in terms of reliance on, or evaluating things. I'm not sure. I think there's such an the basis of all of this is so minimal in terms of any empirical data. And again, it doesn't mean the insurance industry is wrong, but it certainly doesn't mean they're right based on the documents that they've provided in quantity so far, any more than to rely on the plaintiffs' firms. But I think it's great that there's this type of work being done.
Great. So we have time for 2 more questions. Frank Chmielewski and Jeff Stempel in that order.
Thank you. I was interested in the earlier comment from Andrea about reinsurance. I suspect reinsurance has a big part of this. I always have to look to see what they are. XPL is loss in excess of limits reinsurance, and ECO is extra contractual obligations. Whenever you have these giant verdicts, they're in excess of the policy limits. The defendants usually don't end up paying them. They don't have the assets quite often. So there's some agreement between the plaintiff and the defendant to assign the claim over to the plaintiff, like a bad faith claim over to the plaintiff to go against the insurer, and the insurer has to go back against their reinsurers. So the insurer is often not carrying the risk of these large verdicts. It's the reinsurer that's carrying the risk.
I see. Thank you. Yeah, I think bad faith claims and just in general assignment of benefits, I know has been like huge in Florida, for example. So, that makes perfect sense. Yeah. Thank you.
If I'm up, I'm gonna. I hope this isn't the wrong note to end on. And I didn't read the paper closely enough. But do you differentiate at all between primary and excess carriers? Because I think even more than the reinsurers, if we're talking about commercial auto, I suspect there's excess or umbrella coverage as well. And then in terms of the limits control, I yield to Professor Weston's comment about whether or not there was bad faith in some of these excess things. But even if the primary insurer has blown the call on settlement, presumably it goes to the excess. So I would wonder about a trial hypothesis that says if I'm really worried about this, the behavioral differences might be the same on premium payment, but an interesting question to me would be, if I'm a primary carrier, do I want to tender my limits to the excess carrier and let them worry about it more if we have more of these potentially large verdicts? And if I'm an excess carrier that doesn't have much of a role in settling the claims, is that not a group that's going to more aggressively raise premiums out of fear because prior to 2015, they thought their risk of hitting their layer was X, and after 2015, they think it's 150% X or something like that.
Mm-hmm. No, I think that's a great point. I haven't looked at the umbrella coverage rates in particular, but I think I have the same prediction as you would, especially given that they are the next in line in terms of exposure to these. Yeah, so I'll definitely look into that as well. Thank you.
Of course, we want you to do everything. And my final comment is multicollinearity is always kind of lurking, I would assume, in terms of the other factors that affect premiums.
Mm-hmm, mm-hmm. Yeah, I mean, that's what at least in terms of like when I was comparing different lines of businesses, you choose auto liability and just defer the commercial versus private to control for.
Mm-hmm.
Between those two lines, I would just finish by saying that like overall economic activities is a big difference. Like in recessions, commercial auto prices fall much more than private passenger auto. So controlling for that, my sense is that at least I've done an okay job of controlling for other factors that would affect them differentially. But yeah, thank you again for the suggestion. That's really helpful.
Well, okay, it's now 5:04, so we've run past our hour. If anybody wants to stick around, Simon, are you okay to hang out just for a little bit longer, just to chat?
Absolutely.
But otherwise, you're all electronically excused. Thank you for coming, and come back in 2 weeks. And thank you very much for a great talk on a very important and under-researched topic area. So thanks.
Thank you, everyone. Good program.
Thank you.
Bye.